Good afternoon. This is Mark Sebastian. This is the Option Pit Simple Trade of the Week example. Now, again, this is for educational purposes. This should not be construed as any type of advice. Consult your financial advisor, not a blog. Now, that being said, let's talk about we did our first kind of trade of the week last week, and it was in CSX. Which is the railroad company. Now, CSX, we had a couple of different trade ideas, and we kind of settled on the 38 calls for $1.25, and those are up small. All right. However, CSX seems to have slowed down, and volume seems to have slowed down. I've seen these trade this week. If you want to follow the cost. We saw these get as high as $1.50 and as low as about a dollar. And now they're trading around 135. So my feeling is the Mo kind of flattened after Monday's open when we got to that $1.50 level, and I can get out of this with a small profit. I'm probably going to do that. I don't see a lot of reasons to be in this trade for the long haul. I still think CSX is going to meander higher. I do, and I think somebody sitting on these calls is going to end up doing well. If I did the call spread from last week, I would be much more inclined to stay in that trade, and actually, I would be just as inclined to do that trade this week. So an alternative would be to turn it into a call spread. We saw these calls get almost to $1. I think that's a bad price. We saw these calls get as really they've been hanging around this price the whole time. They're getting a little bit of a bid today. So today's not a bad day to lay into this call spread. You're going to own it for cheaper than we could have last week, than I could have last week. So that's kind of an update on CSX. Now let's talk Facebook. All right. So I'm not going to be talking about CSX next week. All right. At this point, I'm only going to do these trades. My goal is to follow them for a week tops, and that's really about it. Facebook. Talk about a name. It's right near. It's come off this all-time high a couple of times, and it's had some of these little weird, ugly trips. Earnings were great, but it's off on them. So now here we are, and the stock is right at kind of support levels. All right, as I see it. All right, the 200-day moving average is 77. So maybe there's $1 to the downside. Stands any serious market sell-off. I just don't see it, and that's probably the lowest we're going to go. At the same time, volatility, the implied volatility, is off the absolute lows, but it's still just dirt cheap, toilet low. All right. So I'm looking at this, and that implied volatility is just inexpensive. Same thing with the 60-day, although the 60-day is a little higher, not much. All right. So then as I look across the term structure, you can see the volatilities at all these different points, right? May. So you take a look, 22, 20, 22.90, 22.90, 22.90, 22.70, 22.90, 23, 23 and a quarter, 23 and a half. So I can go all the way out to July and really not pay for anything, pay a volatility premium. And take a look at these skews. We'll go out to July, and I'm just going to leave the regular monthlies up. I don't need too many of these. All right. And you can see here are the 10% strikes. All right, so I'm not going to do May. And we get kind of a feel for where premiums are. The 85 calls in particular look just disgustingly cheap in both July and June. That's a good looking calendar spread right there. But in this case, I'm not usually a big proponent of buying out of the money calls, but I just think July upside looks really inexpensive. And I think Facebook could rally. But then again, you know, would I rather, so here's the question that traders ask themselves. Would I rather pay $1 for the July 85s or go 2.5 points closer and pay 65 cents more? All right. And it's a lot of ways it's 6 of one, half dozen the other. There is a lot more liquidity at the 80 strike. I think those could do pretty well. And I think they're a pretty simple trade. I like owning the July 85 calls for $1. My goal, I think I can sell those at $2. Now this may be a little longer of a hold, but probably not that much. I think Facebook, you know, if we look at a 3-day risk chart, come on, gotta put the trade in there. Oops. All right. So what I want to show you is, okay, we're going to go 8 days. So what I'm going to do is I'm going to drop volatility a little bit. Drop volatility by 10%. I'm going to show you a increase or decrease of 10%. And I'm going to push the date out to next Friday. All right, and if I get any lift in volatility, I've made 50% on my money, up 2%. And I'm better than break even. And this is in a week. So in a week, if volatility hits an all-time low, so sub 20, if implied volatility in Facebook hits below 20 next week, and it's up 2%, I break even. If it's the same or up moderately, I'll be up between $28 and $50. If it gets a little better move, so more like 4%, I'll be in a position to have doubled my money. And then I'm playing with house money. All right, and that is why I like this Facebook trade as a potential long play. And yeah, I'm using July. Why? That decay is going to be slow. So there you have it, folks. I'm going to try and pay, you know, the most I would pay on these is, not what I was looking for. You know, somewhere between $1.05 maybe. So I'm going to modify my trade because they're actually already increasing the volatility. All right, we've seen 104 just trade. So I'm going to bid 104. All right. See if I can get filled there. All right, and that's not going to happen. So I'll just pay, I'm going to pay the piper. I'm going to pay up to 105. Wow, that may be faster than I thought here. All right, and that's going to get filled. I'm going to pay a 105 top. All right, folks. If you've got questions, you can email me, mark@optionpit.com. You can call us, 888-TRADE-01 or 888-872-3301. All right, folks, have a great weekend.